叫你用电脑啦。
你用这个的。
哎，我讲要不要计算机？
然后我刚问两把，讲好。
所以我们3个买啊。可以。
Okay,
你定啊？
let's begin our today's class.
我再看你这边哦，没有什么特别吧？我不想看那个 screen，那个太远了，这个很难看。
Okay. Okay, these are stuff. Okay, so for today's class, we are going to look into risk and return. So tutorial 8. So another questions, 20 marks as well in your exam. Yeah. So just like your last week tutorial as well. So it's quite important. Okay. So for today's class, you don't really have to use financial calculator. You just use the normal calculator with you. So first of all, we look into some formulas that we use for individual asset. So when we look into a single stock or individual asset, if I were to calculate the expected returns, this is the formula that I'll be using. So when I talk about expected returns, I'm talking about the means, or we call it as the average returns. Okay, so expected returns are based on the probabilities of the possible outcomes. So therefore, when I look into the formula of the expected returns, okay, I will look into the probabilities, okay, of the return to happen and also the return itself. So I use the probability times the returns and I take into account all the summation, and that's how I get the expected return for the individual asset itself. Okay, so I take into account two components, probabilities and the returns times each other, and I get the expected returns over here. Now, I will also need to calculate variance and standard deviation. So when we talk about variance and standard deviation, the purpose I want to calculate standard deviation is because I would like to find out the risk. So standard deviation is the measurement of the risk. So how do I calculate that? I have to look into the difference, okay, the difference between the individual return, okay, minus the expected return. So where do I get this expected return from? So expected return is basically from the calculation just now, and I compare the individual return with the average return that I just calculated, and then times the probability and take into account all the summation. That's how I get the variance, and then square root it, I will get the standard deviation. So variance and standard deviation is for me to calculate the risk itself, to see the differentials between the returns that I earn as compared to the average return that I've calculated. So I'm going to use an example to show you. So for example, suppose you have predicted that the following returns for stock C. So we have one stock here, one asset, and stock T, and the asset in 3 possible states of nature. What are the expected returns? Okay, so we are looking into we are looking at it as a single asset. That means we look into it as a stock C first, and then followed by stock T. So I will see from this perspective. So from up, okay, from up, that means so I will see from the top here. Okay, I want to see from here, from the top here, C first. I want to look into the stock C first. So for stock C, okay, there is a probability of 30%. Okay, it will have the boom state with this return. 50% with the probability of having the normal state with that return. And what about the rest one? So the full probability is 1. So 1 minus 0.3 minus 0.5. Okay, the rest is 0.2. So 20% that in the recession state. Okay, and then you have the returns on the asset itself. So I'm just going to times each other. 0.3 times 0.15. Okay, 0.5 times 0.1, 0.2 times 0.02, and that's how I get 9.9%. Or you can call it 0.099. Okay. Now, similarly, if I were to look into asset T, again, remember when you look into individual asset, I look from the top. Okay, so similarly, there are 30% of the probability in the boom state with these returns. Okay, 50% probability in the normal state with these returns and 20% of the probability in recession with this return. So I'm just using this probability times this return, probability times the return, probability times the return, and then I add up all the summation. Okay, so at the end, I get this amount. So once we get these two amount, what are these two? These two are what we call as the average return, or we call as the means. So once we have the means, I can use it to compare with the individual return itself to find the variance and standard deviation. Okay, so if I were being asked to calculate variance and standard deviation, okay, so first of all, I look into stock C first. You see, when you look into individual asset, you look into it like separately. Like first one, stock C first. So we know that there are 30%, okay, 30% in the boom state. So where do I get the individual return? I get from the table here, which is this 0.15. Okay, 0.15 minus the 0.099 that I got. Okay, because 0.15 is the individual return during the boom state, okay, for the stock C, minus the 0.099 that is the expected returns, which is my average return. I want to see how far it deviates from the expected returns that we calculate. So these two minus each other times the probability, and then remember you have the power over here as well. So you minus each other, remember to power it, okay, square it, and then times the 0.3, okay, and then followed by the next one as well. You know that there is 50% in normal stat, okay, and then the individual return is 0.1, so 0.1 is here, minus the expected returns 0.099, okay, do not forget the square as well, and plus the last one as well to see the differentials between the individual return 0.02 minus the expected returns, square it, and then times the probability, okay, and at the end you get these answers. And do not forget, this is variance. If I have to calculate standard deviation, I have to square root it and you get these final answers. Okay, so same thing here. If I use another color pen for stock T, okay, I look for the differentials first. Individual return is 0.25 here, okay, and the expected return is this one, 0.177. Okay, so minus these two squared and then times the probability. Same thing, use the individual return minus the average return squared and then times this one as well. Okay, and do the same for the last one. So at the end, you get this amount, square root it, you get these answers. Okay, so what we have gone through for the first page here is individual asset. So when you approach the exam questions, the first two questions will definitely be individual asset. Okay, for this topic. So one conclusion we can make is when you look into it from the perspective of individual assets, you see when you calculate, you see from the top to the bottom. Okay, from top to the bottom. Okay, now we are going to look into the second scenario in which we look into a portfolio of assets. That means we are no longer looking into a single asset anymore, but we look into a portfolios. What is the meaning of portfolios? Portfolio means a collection of assets. Like when I talk about portfolio, that means like, for example, in your collection of assets, you have different kind of stocks. Okay, different kind of shares of different companies. Okay, so first of all, how are we going to calculate the expected returns? So it will be a bit different. Okay, so here we look into the weighted average of the expected returns of the respective assets in the portfolio. So still the same thing, but the weightage is being taken into account. Okay, weightage is being taken into account of the expected returns to calculate the expected returns of the portfolio. So that means in the portfolio, I have more than one asset. Okay, so let's have a look into this scenario. Consider the following information. Invest 50% of your money in asset A and how much in asset B. So 50% in asset A, the rest is in your asset B. So that means another 50%. So this is another 50%. Okay, so you have asset A and asset B. Okay, so we know that there's 40%, it will be in boom state. If it's in boom state, the returns will be 30% for A and negative 5% for B. And during bust, 60% to in the bust state, the returns will be negative 10% in A and 25% in B. Now, what happened is in this scenario, right, we cannot look from the top anymore because I'm looking into my portfolio of assets. You have to see from the beside here. Okay, you see from here, left to right. One tips here. in case if you do the mistake. Okay, so if I calculate individual stock, it will be easy. Like I see from the top to the bottom. So I do not want to cover the right hand side, this one already. I want to focus on the bottom one because now I want to look into portfolio. Okay, so first of all, I invest 50% in A, 50% in B. Okay, and during the boom state, I know that I will get 30% of returns from A and negative 5% in B. So therefore, I straight put my weightage in with the returns. So weightage is 0.5 times the returns, 30%. Okay, and then here I put everything in percent. If you change to decimal, then you must make sure that everything is in decimal. So this one, the example that I used, they already put everything in that percentage. Okay, so the 30 here is 30%. Okay, another one, 0.5 times negative 5. Where do I get all these figures? 30 is here, negative 5 is here. So where do I get 0.5? 0.5 is the weightage. How much I invest in A and how much I invest in B. Okay, so times plus up, add up each other, you get 12.5%. So this is the portfolio return during the boom state. Okay, during the boom state. So you see in my portfolio itself, I take into account of A and I take into account of B. Okay, and I take into account the weightage. 0.5 is the weightage. So one thing that's a bit different over here is that you take into account the weightage here as compared to the individual asset. So similarly, now when I look into portfolio return in the bar state, again, the weightage is 0.5, 0.5 for each. So I know that for A, the return is negative 10 and for B is 25%. So I put that in as well and then plus up each other and I get this amount. That's the portfolio return in bus. Okay, so at the end, I will have the portfolio return in boom and portfolio return in bus. Okay, and I know that it's 40% for boom to happen and 60% for the bus to happen. So I will use 0.4 times the expected return for boom and 0.6 times the expected return for bus. Okay, and therefore at the end I get these answers, which is 9.5%. So one thing you can realize that the answer to get for calculations of the portfolio assets, it will be an average. That's why I call it as weighted average. Why I call weighted average? Because your answers will definitely be in between of this amount and this amount. It will definitely be in between, is an amount that's in between of the largest portfolio return and the lowest portfolio return. So it must be less than the largest asset return and greater than the smallest asset return. Okay, so it will be somewhere in between. Because it's a portfolio assets, we are trying to calculate the average. Okay. So again, these are the another two questions that usually you will be assessed when you want to calculate the portfolios. Okay, the next one. So later we are going to come across more questions about those portfolio of assets and individual asset. And for portfolio, you may require to calculate the variance and standard deviation as well. Okay, so we will come to that later on through the practice. Okay, so some theories that you need to know. So the first theory that you need to know in this chapter itself is the difference between systematic and unsystematic risk. So when we talk about the risk itself, the total risk combines of both components, which is systematic and unsystematic. So risk itself is measured by standard deviation. So what's the difference between these two risks? The first one is called systematic risk. Systematic risk means something that you cannot diversify, something that you cannot avoid as well. So this is what I call as non-diversifiable risk. That means something that you cannot avoid from, or you can call it as a market risk, a risk that everyone will face. Okay, so these are the risk factors that affect a large number of assets. So not only your asset being affected, it's basically all assets being affected. Like for example, macro issues that are happening in the country itself is considered as a systematic risk. The rising inflation, the change in the GDP, whether the country is doing good or bad, the exchange rate of the country or the interest rate in the country, all these are part of the macro issues in which none of us can avoid from. So therefore, we call it systematic risk. Okay. On the other hand, we have unsystematic risk. Unsystematic risk means it's a risk that you can diversify it, you can avoid it, or we call it as a unique risk. Unique risk means that the risk that's only applied to your asset, to your company that you purchase, to the share that you purchase. So it's an asset-specific risk. It does not affect everyone, but only affect those, like for example, a specific industry. Okay, so therefore, risk factors that affect a limited number of assets only. Example, maybe the company that you purchase got labor strikes. Okay, so your company, your share is being affected. You have the company that you purchased got shortages, and therefore, what happened is your company share will get affected. There's a planned disaster happening, so the airline industry is being affected, or there gets a strike, so the company is being affected. So it's either the particular industry or the particular company is being affected when you talk about unsystematic risk. So theoretically speaking, when you invest, you should try to avoid unsystematic risk. This is something that you can avoid. But systematic risk is something that you can't avoid at all. Okay, so therefore, that's the one thing that you need to know. So therefore, now we know that this unsystematic risk can be avoided from, but systematic risk always be there. So this one is always be there. Then how can we reduce the risk? One way to reduce the risk is through diversification. Okay, to buy different assets. So to reduce the variability of returns and to reduce the unsystematic risk. Okay, so that when you invest in different sectors or industry, the one that is expected, the one that is being performed badly can be offset by the better than expected returns from another asset. The good one can offset the bad one. Okay, so in share market, only beta is awarded means what? Beta means systematic risk, a risk that you cannot avoid from. So only if you take the risk and the risk is systematic risk, only it can be awarded. Because in stock market, we say that high risk, high return. But the risk here that we are referring to is systematic risk. Okay, if you go and take some those unreasonable risks, like those money scheme, okay, you assume that those are risks, is wrong, okay, because those are unsystematic risks. So if it gets into trouble, you lost all the money, that's basically you make the wrong choice, you make the wrong risk management. Okay, so when we talk about high risk, high return, the risk here must only be referring to systematic risk. So then only you can say higher beta, higher returns. Okay, because unsystematic risk can be diversified. So like for example, few months ago, last year, we have this several dynamic that was being suspended from the stock market. So several dynamic, there are a lot of rumors. Like for example, there's a lack of transparency in this company itself. Okay, basically this is a company of oil and gas sector. Okay, so what happened is they already have been making losses, and there's one red flag being shown, which is last year I think they were not being able to publish their annual report, so they get into some troubles. So at the end, it got suspended. So therefore, if let's say when before you invest in this company, because a lot of people invest in this is because I think the share price dropped a lot. So you know, like some investors, right, or some people, they want to earn from the penny stock, so they want to invest in this kind of companies because you do not have to use so much of starting capital and you earn a lot from the company itself. So therefore, when they realized that the companies were doing so badly and the share price was so low, right, everyone, a lot of youngsters will enter. But that's what we call as unsystematic risk, because before this they already got red flags. They are making a great loss. They are making great losses, and at the same time, there's a lack of transparency. Until last year, it was being announced that they are not able to publish the annual report. Then that's when it got suspended. So if you invest in this company, you got in trouble. So when you invest in this kind of high risk company, that does not give you high returns because that is not a systematic risk. Okay, you can see this one that I highlighted over here. They have already been making a losses, and that is why they are also not able to publish the annual report as well when they were being asked. Okay, last year. Okay, and another example as well, like for example, Asia is another loss-making company as well. Okay, and let's say you purchased because when COVID happens in the midst of pandemic, you know, like it dropped a lot. Okay, the share price went down a lot. So again, if you are aiming something like what we call as the penny stock, then again this is something that usually people will look for because it is less than $1, one ringgit. And then if you are aiming to use low starting capital to purchase this kind of companies, then maybe you might be thinking to earn a great chunk amount of money. You still can, but pandai lah. But the thing is this, there are already some red flags as well. Like for example, they have already been making losses. And during pandemic, if you buy this kind of what we call as the travel industry, then this is what I call as unsystematic risk again. Because when pandemic happens, it hits the traveling industry one. So therefore, again, this is what we call as the unsystematic risk as well. Okay, but it depends on though. Like for example, in the midst of pandemic, I purchased Genting, because Genting the share price dropped a lot. Yeah, and then make a very good decent amount of money. So it depends on. So I think it depends because for Asia they have already been making losses, so therefore there's already a red flag over there. So although they are being hit badly during pandemic, but I feel that if you enter at a good price, you will still make a good chunk amount of money. Okay. Now, so what we can learn here is that high risk, high returns. Okay, and now I want to talk about risk premium. So risk premium means that today, right, when you accept more of the risk, you expect a higher expected returns. So the formula for risk premium is expected returns minus risk-free rate. So what is risk-free rate? RF. Risk-free rate means usually we are referring to the returns that you can get when you invest in those risk-free assets. That means no risk asset. Example like what? Bonds. Bonds is what we call as risk-free. Okay, because you invest in bonds, you are going to get the returns anywhere every half a year or every year. So whether the company is doing good or bad, you still get the returns. And so therefore we call as risk-free rate for bonds. Okay. Now, how is this formula is being derived? Okay, so you see, first of all, this graph here, now you do not need to know how the formula is being derived. You just need to know we are going to use the formula later on. I'm just showing you how the formula is being derived. So on my y-axis of the graph is called expected returns, ER, expected returns. And on my x-axis here is beta. What is beta again? Beta means the risk. So makes sense, right? The higher the risk, the higher the expected returns. Correct or not? So you see today, if I aim for higher expected returns, then I have to absorb more risk. What kind of risk is this? The risk here is referring to the systematic risk. Okay, so like for example, if I accept the risk up to this amount and I draw the graph, okay, draw up to this red color point over here, and you can see this is the expected returns that I'm aiming for. If I take this much of risk, I will expect this amount of expected returns. Makes sense, right? The higher the beta, the higher the expected returns. Therefore, the graph is an upward sloping line. Okay, and you can see this is a risk-free rate, the risk-free expected returns. Why is that? Because that is the expected returns that you can get if you invest in risk-free assets. Make sense? Now, there's one problem. I want to find the gradient of this red color line from this one to this one, the gradient over here. But are you able to find? You can't because you do not have any information being given over here. So therefore, we have to use some NMAX formula, which is the sin cos tan. So I can draw it to use the tan theta. Okay, so opposite divided by adjacent. Okay, so opposite is this A, adjacent is B. So with A and B, what can I calculate? I can calculate this one here. Okay, I want to find a gradient. Okay, so therefore, my opposite here is A. So A is this expected returns of this asset minus the risk-free rate. Betul? Yeah, so therefore, that's how this formula is being derived. Okay, what about B? B is adjacent. Adjacent is from 0 to this amount of beta that I accept, right? So this amount is my B adjacent. So I use beta A, the risk that I accept for this asset A minus 0 because it starts from 0, then it becomes my adjacent. So I got opposite and adjacent, then I can calculate my tan theta. Okay, so that's the gradient already. Yeah, so therefore we form this formula. Okay, now in the market equilibrium, okay, assuming when we talk about the security market line, that means I'm referring to the market equilibrium. In the market, we always assume that the risk itself, the market risk always equals to 1. Assuming, okay, assume this is an assumption. We assume that in the market, the beta, the risk that we accept is 1. So if let's say beta is 1, I put 1 here minus 0, my denominator over here will still remains to 1. So it's not important. I can just ignore it. So therefore, at the end, I have this formula on the top only, which is the expected returns minus the risk-free rate, which is the derivation of this formula. So risk premium, that means that the rewards of accepting more risk is basically I use the difference between the expected returns minus the risk-free rate. Actually, just go one big round to show you the formula only. Okay, so therefore, now this is the formula for risk premium. Okay, so this is the formula that we're going to use later on as one of the formula to calculate the risk premium. Okay, so now I can link it to this capital asset pricing model. Okay, why? Because capital asset pricing model looks into the relationship between the risk and the return, which is the gist of today's topic. Okay, so therefore, the expected returns of the asset A itself takes into account of the risk-free rate, because when you want to invest in the asset, you definitely want to expect the returns is way larger than the investment that you make for the risk-free assets, right? So risk-free plus the beta of the assets, the risk that you accept, times the risk premium. Okay, the expected returns minus the risk-free rate is the risk premium. Okay, so therefore, you can write it like this. Expected returns of an asset equals to the risk-free rate that you expect to get plus the rewards that you get from taking the risk. The risk that you take and then associated with the risk premium, because you assume that the more risk you take, the higher the risk premium. Okay, so therefore the expected return of one asset rely on these factors. So I can rewrite into risk-free rate plus beta A bracket expected return of the asset is expected return of the asset of the market, okay, minus the risk-free rate. Okay, now, so therefore, this is what I call as CAPM model. But so from this formula itself, we learn one thing. Okay, there are three things that can affect the expected returns of an asset. Okay, the first one is risk-free rate. So, risk-free rate will affect the expected returns. Okay, because when the risk-free rate is increasing, you will expect a higher expected return of your asset as well. Positive relationship, positive figures, man. Okay, it is positive figures. And then we have the risk here shown by beta, amount of systematic risk. The higher the systematic risk, the higher the expected return as well. Okay, positive relationship as well. And we have the risk premium as well. So the higher the risk premium, the higher the expected return as well. Okay, so we have three components that will have an impact on the expected returns that you wanted to earn from the investment itself, from this CAPM model. Okay, so that's the thing you need to know for this topic. Okay, once you are done, you can have a look into the direct question first. Okay, so first one, systematic versus unsystematic risk. Okay, so let's just go through quickly. The first one, short-term interest rate increase. So macro issue, increase interest rate, so systematic. Interest rate a company pays on its short-term debt borrowing is increased by its bank. Of a company, only affects a company, so unsystematic. Oil prices unexpectedly decline, so it can be a macro issue as well. So it can be both. It can affect the market, and also it can affect the company that produce oil. So both. Question D, an oil tanker ruptures, creating a large oil spill. So only affects one company itself, unsystematic. Manufacturer loses a multi-million-dollar product liability suit. So got a lawsuit of the for the company. So again, it's unsystematic. A Supreme Court decision substantially broadens producer liability for injuries suffered by product users. So again, this is a regulations that apply for all the companies. So systematic. Okay. Okay, done. And this one is the one that I told you just now. When you look into portfolio, the value that you get will be the average. Okay, that'll be the average. Okay, let's have a look into calculation questions. Okay, we have to calculate individual asset. So, what's the question? Based on the following information, calculate the expected returns and standard deviation for the two stock. Stock A and stock B. Okay, So what we need to do, where's the question? We have to calculate the two stock. So this is individual asset. Okay, we calculate the individual asset first. So I want to calculate the expected return of each stock. So that means I should look from the top to the bottom. Okay, look from the top to the bottom. Okay, that means I use this amount times this amount plus this amount times this amount, this amount times this amount. Easy. Then you got four marks already. Okay, and then do the same for asset B as well. For asset B, okay, use this probability times this one times this one, this one times this one. Okay, so you will get this one for expected return A and this one for expected return B. Done. Okay, next we want to calculate the variance and standard deviation. So you see, we just remember the formula. Okay, so I use the individual return minus the expected returns. Where do I get these figures? I get it from here. Okay, so where do I get individual return? From the table. Okay, from the table just now. Okay, so therefore probability times the answer that you get. Okay, same thing here. Probability times the difference. Okay, the individual return and the expected returns. Okay, remember, don't forget the square as well, and then do the same for the rest as well. Okay, so remember, this one, the figures here is the expected returns that you calculate, the average. Okay, at the end you get the variance. So this is the variance. Okay, and then you square root it. So you square root, either you put power of 1 over 2 or you put square root. Okay, and then at the end you get standard deviation. Okay, same for stock B as well. Can Okay, now I want to calculate the expected return of a portfolio. A portfolio consists of 80% in A and the balance in B. So how much is in B? 20%, no? 20% in B. Now I have two methods for me to calculate. The first one is to use the method that I learned just now, or another method is because I already have the returns of the individual assets, I can just use the weightage and times. So the method number one, okay, is because I already have the expected return just now. One is what is 8.65%, another one is 12.75%. Okay, I can just put it in here as a decimal times the weightage, and at the end I should get the answers. Also can, this one of the method because I already have the individual returns. So this is the fastest way if let's say you have the expected returns of individual assets. Or another method is we do it step by step. Method 2. This is what we learned just now. Method 2. Okay, so first of all, we know there are three states. So I know that in recession, okay, for the first stock, I will get this return. For the second stock, I will get this return. So I put 80%, 80%, 80% on the first stock, okay, on the first stock, and then 20% on the second stock, the balance stock B, okay, and I get this return. And I know that there's 20% of the recession, 20% for recession to happen, so times 0.2, and this is the amount that I got. Okay, same thing here for the next one. For normal state, I know that for stock A, I will get this return. For stock B, I will get this return. And I put up this portion in stock A and this portion in stock B, and I get these figures. Times the probability, 55% for the normal state to happen, and these are the figures. And last one, for boom, stock A return is this, stock B return is this, and I put 80% in A, 20% in B, and I get this amount times the probability for this to happen, and this is the amount that I got. So I add these three, at the end, I will get this amount, 9.47%, which is the same as this one. Okay, then how do we calculate the standard deviation? So again, so now we are going to use this 9.47% as 9.47 percent. Okay, so again, when we calculate variance, we look into the difference. So again, we look into the difference between the individual returns and the expected returns. Okay, and taking into account the probability. Okay, of course, remember the square as well. So first of all, individual returns. Okay, so we look into individual return. Okay, so first of all, when we look into this return, okay, I will get from these figures. So this is why if you put into table, it will be easier for you because you can get more information over here. Okay, and this expected returns, okay, you get it from this 9.47%. Okay, so therefore, let's see. Okay, so we know that the probability is 0.2, okay, and this is the individual return, okay, the return during the recession, okay, negative 4.2%, or put in decimal, minus the expected returns during the recession, okay, and then same thing for the booming and for the normal, okay, 10.2%, okay, so I put in decimal, so this is the RI, and this is the expected return, okay, and then the last one, booming, again, where do I get this 0.188? I get it from here. So you see all these returns, I got it from the table. Okay, I get it from table minus the expected return. Okay, at the end, I got the variance. Remember to square root it, I get the standard deviation. Okay, so for portfolio, you only do it once. You don't have to do it separately because now we look into it as a one portfolio itself. Okay, next question. Calculating portfolio betas. You own a portfolio equally invested in a risk-free asset and 2 stocks. So how many assets you invest? 3, yeah? One is risk-free asset and 2 stocks. If one of the stock has a beta of 1.45% and the total portfolio is equally as risky as the market. So if I say it's equally as risky as the market, how much is my beta? Market beta, 1. SML, security market line. Okay. What must the beta be for the other stock in your portfolio? So I know that the total risk that I got is 1, and I invest in 3 assets. So 1 over 3 times the what I call as the risk. Okay, 1 over 3, 1 over 3 like this. Okay. Now, so what I'm calculating, I want to calculate what must be the beta for the other stocks in your portfolio. I want to calculate the risk, the beta. Beta is the risk. I want to calculate the risk. Okay. Now, in terms of weightage, so 1 over 3 are the weightage. So all these are my weightage. Okay, because I put 1 over 3 in one risk-free asset, 1 over 3 in one stock, and 1 over 3 in another stock. Okay, so risk-free asset, how much is the risk? How much is the beta? No risk because it's risk-free. Risk-free already, ma. So 0. Okay, and then one stock, the risk is 1.45%. I put it in. This one I do not know. I put it as X. So now I want to calculate X. This X is my beta. So which is 1.55. So this is the beta of the stock X. Okay, boleh. Okay, next question. CAPM. Okay, this one very easy. You substitute figures only. A stock has a beta of 1.25. Expected return on the market is 11.17%. The risk free is 3.5%. What must be the expected return on the stock? Remember, every time you calculate, right, make sure you know whether you are using the percentage or decimal. If you are using percentage, that means at the end, the final answer that you got is in percentage. A lot of students always confuse, they got the percentage already, they go and convert it to the percentage again. So the answer supposedly is correct, but it become wrong. Okay, so usually what I did was, usually what I do is that I will use decimal. I will use decimal and then later on convert into percentage. Okay, so how do we do this? We use the formula. Expected returns of a single asset equals to the risk-free rate plus the risk premium. Okay, so I can rewrite into risk-free rate plus the beta times market expected returns minus the risk-free. So risk-free is 0.035 plus beta 1.25, and then expected return on the market is 0.117 minus 0.035. Calculate it, and then you get the answers. You get 0.1375, convert into percentage, 13.75%. Okay, Sakura. Hey, hi. Okay, next. Another one, CAPM as well. Shh. A stock has an expected return of 12.5%, a beta of 1.4, and expected return on the market is 10.9%. What must be the risk-free rate? So this one, you just substitute everything in. Use back the same formula. You have the expected returns. You do not have the risk-free, but you have the expected returns over here. Again, you don't have risk-free, but you have beta. So move around to calculate this risk-free. So at the end, you get these figures. Okay, so follow the methods and do this. Okay, once you are done, have a look into these extra questions. This is the question that you come across in your exam. Okay, so you with the table being given, you try to calculate A, the expected return of each share. Okay, B, you calculate the risk. In order for you to calculate the risk, what do you need to have? You need to have your variance and your standard deviation, right? And then question C, okay, assuming we are talking about the expected return of portfolio, okay, expected returns on portfolio, okay. Let's say now we have 40% in share A and 60% in share B. So what is the expected returns? And what is the risk? And lastly, what is the risk of this portfolio? Again, variance and standard deviation for portfolio. So the first two questions is individual asset. Okay, and the next two questions is on portfolio. Try and do this and I'll show you the answers. Or maybe you can take a photo as well if you want to. Oh, you all have the documents ready. So basically the answers are here. Okay, you can take it as a reference. Ignore the last one. This part here you can ignore. You can ignore. Okay, the answers until there only. Okay, so remember these are the 4 questions you'll come across in the question that assess your tutorial 8. So these are things I want to cover for today's class.